To help us out with that, we have Siddhartha Khemka, the head retail research at Motilal Oswal Financial Services, who joins us on the show. Hi, Sid. Good morning. Well, the Nifty has got to chase down these runs, so to call it today, and the captain of the ship needs to do well. HDFC Bank. What's your view? Do you believe its time has come at around this 1,530 rupees odd? Would you be a buyer? Are you constructive on the stock from here on?
Very good morning, Nigel. If you look at HDFC Bank, I think finally the bank has kind of overcome the merger overhang, and now they reported the first merged entity results. And to be honest, it was, you can say, mixed, but not that bad, given that the initial feelers that we got was a bit on the pressure side, that the expectations was built on the lower side. And hence, I think the numbers kind of delivered in line with expectations. If you look at the key numbers, yes, the PPOP and the NII were both in line. The business growth has been quite robust. PAT was aided by lower tax and lower provisions, but higher than expectations. Margins, if you see NIMs, a bit tad lower. It was expected to get compressed, but a bit lower than expectations. So I think the street would be broadly okay with these kind of results. The good part is the management commentary saying that growth from here looks pretty strong, and they would only build up from here. As I said, they reported a beat on profitability owing to healthy other income and lower tax rate. Loan growth was healthy, driven by the growth in retail as well as continued traction in the commercial as well as rural banking. There is enough buffer for with the PCR at 74%. Hence, we believe that HDFC is making a good beginning and has a huge pace of capacity building, which is with the levers in place for the strong business growth, which is key for the market to start rewarding. The stock has kind of underperformed in the past, and largely because of the overhang of the merger and how the numbers would look like post the numbers. From here, we are expecting HDFC Bank to deliver an 18% loan and 20% deposits CAGR, which should lead to a 21% growth in earnings and translating into a steady ROEs of 2%, ROEs of 17%. So I think the ship is steady from here, should start delivering returns to investors. We definitely have a positive view and a target price of 1950 with a one-year target of 1950, which gives a decent 30%, 27-30% upside from current levels.
Okay, 1950 is your target price. That's a big upside from the current levels. The other stock I wanted to discuss with you was CEAT. Now, there's been a steep rise in profitability, a big jump in margins as well. But the stock also, if you look at it in the last 6 months, is up about 50%. Is there more scope on the upside?
Sonia, if you look at the auto hangs, they have been doing well after the supply chain issues that got resolved. Demand has been pretty strong. And if you look at the key segments, passenger vehicle segment has kind of done well. Specifically, if you look at CEAT, the overall business growth was strong. Net sales grew just 5.5%, 4% Q on Q. And it was kind of sequential increase in the volume was led by strong OEM demand, which was kind of filling in the inventory before the festive season. Replacement and exports volume has been pretty stable. The good part is the margins, gross margins expanded almost 10 percentage points Y on Y, and on a sequential basis, 230 basis points on a Q on Q basis, which is quite heartening to see, especially for a commodity business like tires. So I think overall, the numbers have been pretty good. The company has kind of lowered its debt also. EBITDA has been pretty good, and the demand looks quite strong. We have a positive view here again, and kind of look at the entire auto ancillary space with a positive view. So we have a target price of 2850, again more than 30% upside, you can say, from current levels.
Okay, all right. Just stay on. We'll come back to you, Siddharth, in a bit. We have another stock that we're going to... Khemka is still with us, so let's get some more calls out of him. Siddharth, Bajaj Finance is the one that everyone's going to be tracking this morning. I mean, today, because of the numbers. What's your expectation this time around, and how are you positioned on the stock?
Yeah, Sonia. So if you look at the overall earnings, we have been pretty positive on specifically if you see the banks and the financial services. So that is, and within that, Bajaj Finance, we are expecting to lead from the front. Overall, for the NBFC lending business, we are expecting a 26% NII growth and a 35% PAT growth for the quarter. This is for the aggregate lending NBFCs within our coverage. And within that, if you look at Bajaj Finance, which has already reported a 33% YoY growth in its AUM, NIMs will kind of contract marginally 30 basis points, but the asset quality will see some improvement is what we are expecting. So overall, as I said, OPEX likely to moderate, credit cost is expected to decline, and net profit growth of 31% to 36.5 billion. So I think a pretty steady quarter from the market leader in the NBFC space. We are quite constructive on Bajaj Finance and target price of excess of 9,000 there.
Siddharth, what about Grasim? They've come out, they're saying they're going to go ahead with the rights issue, and it'll be a small dilution, at 4,000 crores approximately. The bigger news is that they've clarified that no, none of that money is going to, group company, because they've listed out capex, debt repayment, and corporate purposes. So lending to group company doesn't come in there. How do you view the stock from here on?
Yeah, Nigel, so I think the clarification was much needed, especially when you have a group company in the telecom business, which is bleeding money and requires a lot of capex infusion. But I think the fundraise for Grasim will be a positive step. It will definitely elevate the pressures on the balance sheet. If you look at the company has undertaken substantial capex of almost 10,000 crores in the new growth sector, specifically the paint business. And the management, as you rightly highlighted, has outlined a capex of 5,700 crores for FY24, which includes business almost 4,300 crores for the paint business. I think definitely the core business, if you look at for the Grasim, the caustic soda prices have started to improve, which should be beneficial from Q3. The VSF prices has also started seeing improvement in the global markets, and that should also kind of start helping the other business for Grasim. So I think this fundraise will definitely improve the balance sheet and should lead to some improvement in the overall valuation. Our SOTP target price is 2380, which is about 20% upside from the current levels.
All right. Thanks a lot, Siddharth, for joining in, and have a great day. That's the word on several companies and how you should be approaching them. But we have a market to trade in just a while from now. Mitesh Thakkar and Sudarshan Sukhani